Here we have a bar study on the Euro futures 15-minute time frame. Now this study combines the basic use of volume as we rally, volume increases, and the inclusion of bar by bar analysis. And this is the preferred way of using price and volume. We amalgamate the principles. Let's go through this chart. For context, we are in a downtrend. However, I couldn't fit all the data on the slide. So bar A, what do we notice? We drive up, good spread, firm close, and I guess we'd have to say decent volume. We don't have any other data at the moment. Now B, what do we note about B? Well, it's lower volume, but similar. It's similar volume, yet the spread has narrowed significantly. In fact, it's less than half. And we note the close is mid-bar, and also the thrust has shortened. There is a lack of follow-through. Okay, now this is a very important concept. Think, we push up here, it looks like good buying, and then we push up, or try to push up, with similar volume, yet the spread has halved. And the close is mid, off the highs. Look how much progress we make from this close to this close, with similar volume. There is a lack of follow-through. So we know the market is having trouble as the movement has been thwarted. Why is that? We have the same force of buying, which is volume, yet the spread is much, much narrower. So therefore we know that only selling can do that. So selling must be present in this bar. Otherwise, for that volume, we should have a spread from here to at least here. And from B to D, what do we know? Well, the spreads increase, some good closes on the lows, and volume increases. So we'd say this is selling of good quality. Give it a positive sign. Then what happens at E? E is very interesting. The market halts here. The spread narrows, as we can see. The volume is fairly light in comparison to D with the spread, but if we double the volume to about there and we double the spread, we have the same size spread, but we would have more volume. So although E halts the market, we can tell there must be some, although it is an up bar, we know it's having a struggle to push up due to the volume. Okay. What's interesting is we get a good move down, then all of a sudden, boom, we suddenly halt, but there's no continuation from D. And I find that's interesting behaviour. And then F, the 4 down bars. I'll just circle these for you here. What do we note about F? Well, all of a sudden, the selling has no real impact. The spreads, as we come down, have narrowed. See that? Just have a quick look. These 4 bars, wide spreads closing weak, increase in volume. These four bars, no ability to really push down the market, very weak, very poor price action, close off the lows, volume decreases. So although we are making lower prices here, the market is having difficulty. It's having a tough time. The selling quality has clearly deteriorated. I mean, that doesn't mean we buy here. It's just something to note. You know, we have shortening of the thrust. So the follow through from here to here is not convincing. We can visually see that the selling has deteriorated in the price action with the volume and the closes, especially when we compare to these four bars. Worlds apart. Worlds apart. From F to G we rally. And what do we note? Some good buying. Some good buying. With volume increasing and we're closing firm. And look at this one bar here. Breaks this high, this high, this high, this high. Over this close, this close, this close, this close, this close. There is demand in this market. After we have seen this poor selling. Again, this doesn't mean we go long, but we note the behaviour. And bar G itself is very interesting. Why? Well, it dips under the previous bar to reverse and close firm with a nice pop in volume. And we have noted that volume all along has been increasing. So for all intents and purposes, we would expect, so none of this exists, we would expect from bar G some upside follow through. There's no reason not to think that we would have higher prices after we dip under to reverse and close firm. But this doesn't happen, and the next bar reverses to close on its lows with lower volume. Okay, no surprise. Why? Because they're selling here and they're selling here, and we are in this wide spread down bar with the highest volume on the chart at this time. So we are trying to rally through an area of supply, but we'd still expect some sort of follow through from G. But this doesn't occur. The next bar reverses. And from this point, or I'd be thinking, okay, we're going to come and test this support level. Then from G to H, we trade sideways. This is a 15-minute chart. So for an hour, we are unable to pull back. We can't fall further. There's choppy price action. We have a down bar. We have an up bar. We have a down bar. Closes off the lows to be neutral. Another down bar. So these few bars show an inability to go lower. Look, we have this little level here. We can't seem to break this little local level of support. The selling force has declined. Just think logically. Try to tie all these pieces together. So we had good selling from here to here. E halts progress. These four bars we see selling deteriorate. Then we see demand come into the market with increasing volume. And then we try to pull back from G and we're holding. And what do we note? There's no volume here. Look at the volume. So we're unable to pull back. So bar H really is a no supply bar. There's no flow to the downside. Although the volume here is sustained, it is incredibly weak. So we have a story that supply is drying up. The force of selling is diminishing with potential demand emerging. Okay. Bar J, what do we note? Well, widest spread we've seen for 3 or 4 hours with the highest volume on the chart. So let's dissect J. So it pushes up pops its head above the highs, and sellers come in, take it down to the lows here, and then buyers come back in to close it off the lows with all this volume. So the close is off the lows, which indicates buying. And we actually close above the previous two bars. And we hold this little level of support. Don't forget, this is a 15-minute time frame. So this is an hour. We can't go lower, even with all this volume at J. This is technically an up bar. So with all this volume and this wide spread, what does this bar achieve? If it was all selling with that volume, we would print a bar like this under all this price action. Agreed? This is a tricky bar, but technically an up bar with a negative tone because we do reverse from the highs, but buyers are in the market. We know demand is in the market because they were able to push it up from the lows, then sellers came in, and then buyers came in again. They had two bouts of buying. Okay? Then from J to K, we fall. Now here, we can take this chart a little further. Let's add structure. So we fall to K, and now we can see through structure that we've closed under support. And we would think we're primed for lower prices from K. Why? Well, good wide spreads with increasing volume. Yes, we do close off the lows, which does indicate some buying, but we break and we get some good volume. So that validates the break. You get a good drive down like we did from B to D. You can see some ease of movement. And at this point, we would have to say that sellers are in control. And then L. Look at this. A super strong bar. There is a complete lack of follow through. There's no ability to even come up. We don't even revert test down here to reverse and close firm. We just drive straight up with good volume, closing firm, slap bang in the middle of the trading range. It's the biggest buying widespread bar we can see on the chart. This might be a down bar, we don't know. It looks positive, but obviously due to context we don't know the previous bar. So for all intents and purposes, this is the widest spread with the highest volume. And what does this bar achieve? We close back above support, taking out 1, 2, 3, 4, 5, 6, 7, 8 closes. So this is good demand achieving. So the lack of follow through from K is very, very, very important behavior to recognize. The lack of follow through after a break of structure is very important behavior to recognize. This is very, very strong, which is also a spring, which we'll go into in the next session or two. And this is a trade that we have to take right on the close. The force of buying is very strong, and we can see that from the volume. And then we rally, producing a very nice trade. Look at the movement to the upside. Good spreads, closing firm. So all K is a bear trap. When you have hedge funds or syndicates or large players, they're privy. They have more info than we have. And when there's a trading range with support and resistance, they can see all the stops under here. All the resting orders from the new bears who want to join in for lower prices, and also the well-analysed traders who are long from here or perhaps here or here when they recognised, or they may have jumped in here as we break here. Their stops to be under here. So as they're coming down, they get stopped out. adding fuel, adding activity. And most traders do place their stops under support and resistance. And the large players, they trigger the stops by driving price down. And we know instantly, due to bar L, which reverses straight back up with strength. So when L prints, we need to buy that bar. We have to. Yes, it's in the middle of the trading range, but we have a story of strength. Weakening supply, increasing demand. A flush that is instantly reversed, which in price action terms is a spring. Okay? The flush down is orchestrated. It's designed to grab contracts. And this usually occurs around support and resistance. Hence, we don't blindly sell support or buy resistance. Good. Are there any questions? Wouldn't K be a valid break due to the high volume? Shouldn't it have low volume to be a fake move? So shouldn't K... Oh, no, far from it. The high volume, think about it. Volume is activity and it's triggering all the stops. Say there's 3,000 contracts or shares and every tick down, it's 300, 500, and then there might be another 400 here, all the way down here up to 3,000. So every time that's triggered a sell stop or a limit order, someone is also buying. So all that activity is measured in volume. So that's how we know that this was a very successful bear trap. Oh, hold on. We don't know K is a bear trap until L reverses and prints. We are breaking down with increasing volume. Even though we can see supply drying up and with demand emerging, okay, it isn't until L prints. This is the final piece of the puzzle. This makes all this story make sense. And we know bar K is a bear trap, which is very successful due to the high volume. And why the high volume? Because many stops were triggered. And that creates a high volume. It's activity. Every time someone's selling, they're buying. And look at the response. Look at this response. All these trap traders from down here have no opportunity to get out. So we drive up hard. Look at these 3 bars. That is incredible buying. And after a trap like this, you'll often see strong moves, very strong moves up, because they are buying. And there should be less supply in the market. Good question. The 2 bars near G, you say demand is coming in, but volume is higher F. So 2 buying bars near G and the volume. Yes, demand is coming in. We get decent spreads with increasing volume and firm closes. I mean, this bar here, think about it, this bar here is the best buying bar that we have seen since A, which technically we still don't know whether that is an up bar, but say it is. This is the best buying we've had since A, which is nearly 3 hours of trading. And what does it achieve? It dips under these lows, 2 lows, to reverse and close firm. And bar F with the high volume is kind of like E. It halts downside progress with a small spike in volume with no downside follow through. Next bar is an up bar and then a cluster. And then we push up. There's clearly some buying in bar F. How do we know? Well, it's half the spread of D, not half the volume. Probably 10%, 15% less volume. So we should, if all that volume was selling, we should produce a bar about that wide. So we know there is some buying in this bar. The secret, or what's important about this chart, is that we come down with increasing volume, then we come down with decreasing volume, then we rally with increasing volume. But when we come down here, we decrease in volume. There is no ability to pull back. This is when, so after this pullback here, this is when this rally becomes positive. Why? Because now the buying is larger than the selling after we've seen supply decrease. Can you see how this all works, how it all fits together? Now this little amalgamation study of volume has concluded. How we use volume with the bar by bar analysis is important. We always note high volume bars, and importantly bars at structural areas and the lack of follow through. Structural areas, I mean support and resistance, channels, demand, trend channels, demand lines, etc. As this is where many turning points occur, like here. This is the turning point on the chart. And the basic use here, this helps us to feel the force of the selling and buying pressure within the market. It helps us with the flow of buying or selling. Okay, we can see that volume increases nicely. Spreads increase, it helps with the flow. Here we can see a little demand emerging. Okay, so using this example, we can see that the supply has dwindled. It's decreased with every move. Of course, this data is extremely important. If short, we want to be very careful with our positions. We want to take partial profits or tighten our stops, etc. Plus, it informs us to a potential trade in the near future as the market may turn. So we gain an opportunity. And it does this in advance. If we know selling pressure is declining, there should be a turning point. In advance, we're thinking, okay, now we're looking for opportunities to go long. We want to see demand enter and then weak selling. Or we get a big spring like this. It gives us an opportunity in advance. Very important. So by using the amalgamation of volume principles, we are rewarded with a deep understanding of the market. We can really gauge or tap into the force of selling and buying as it unfolds. Now, don't get me wrong, to trade this chart does require a decent level of chart reading ability. Although the selling aspect is fairly obvious to the trained eye, the demand here from F to G is subtle. It does rise with increasing volume. It's not overt. And although the flush down via K, followed by a reversal, is an excellent setup, to the uninitiated, it would be a difficult trade to execute. However, as I always like to say, with time and practice, and as our skills develop, and they will increase during every session of this course, we will begin to gain the confidence and the knowledge to also pull the trigger. Okay? Excellent. If this concludes the study, there are no further questions. On to the next.